Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my very good friend, Adrian Day, the founder of Adrian Day Asset Management. Welcome back, sir.
Well, thank you for having me, Ivan. Good to see you.
Yeah, great to see you. I wanted to get you on as the start of the new year, 2025. And I want to get you on to talk about everything that's happening in the markets, silver, gold, the global economy. But let's start off with gold and silver. What do you think the outlook is for precious metals for 2025?
The outlook for 2025, I think, is very, very positive. What's been happening in the last month or so is really very interesting. To me, it's very interesting. We've had obviously gold has moved back up from the correction that we saw after President Trump was elected. And it was strong even on Friday in the face of the U.S. jobs report. But what's going on is that it's a continuation of central banks buying. We don't, of course, know if central banks are buying on Friday. They don't report that. But we know that there's been buying in November and December. So one can surmise, and continuation of buying from Chinese consumers. And at the same time, we are seeing really, I won't say massive, but I'll say steady outflows, from particularly from the US and Canada, from North America, a little less so now than in Europe. But, this blew my mind when I looked up the numbers just for this. You look at the GLD, which is the largest gold ETF. Since the end of November, there's only been 4 days with inflows.
Wow.
4 days with inflows. The rest have seen outflows.
Okay.
You look at SLV, you go all the way back to the middle of November, and there's only been 7 days with inflows. Seven might sound like a lot, but we're talking nearly 2 months.
Oh, that's crazy.
It's crazy. So we are still getting outflows from North American investors, and what's driving the market is Asia and central banks. But I think that's got to change. I could have said, and probably did say, no, not probably, I did say the same 6 months ago. But, when you look at what the Fed and other central banks, the ECB, the Bank of England, Canada, when you look at what they're doing, they are cutting interest rates before inflation has been conquered.
Right.
And Jerome Powell, the Fed chairman in particular, is in my view, going through contortions, trying to show that inflation is more under control than it is. And the Fed here has started talking about, how we always used to talk about the CPI, the Consumer Price Index.
Right.
Then it was the core CPI for people who don't eat and drive cars. And then it was the PCE. Then it was the core PCE. Well, now they're starting to talk about something called the market-based core PCE.
And what's that?
They're going to cut and dice this darn thing as much as they can to show the prices aren't going up when everybody in the country knows the prices are going up.
There's about $15 trillion worth of physical gold in the world sitting there costing money rather than being used is just absolutely insane. Monetary Metals is bringing gold back into the financial world, putting gold to productive use right now. The problem with gold, of course, in physical form is that it's heavy, it's cumbersome, it's not particularly easy to ship, and it costs money to store in a protected manner. This platform Monetary Metals created is a proven concept and allows gold to be put to productive use. So instead of sitting there costing you money, it's actually in use earning you money.
Learn how you can earn 2 to 5% in our leasing program and how accredited investors can earn up to 12% on silver paid in silver. This advertisement is not investment or financial advice. Minimum investment applies.
So anyway, the point is when the Fed, the European Central Bank, and other central banks are cutting rates before they have firmly killed inflation, that is a recipe for stagflation, and that's a recipe for gold going up. So at some point, you see the S&P here rolling over. The peak was back in, the beginning of December. So, for a month and a bit, for 5 weeks, the S&P has been rolling over, going down. A lot of the erstwhile leaders are falling or
Hmm.
losing their momentum, certainly. And so I think we're going to see a continuation of that. If we see the US economy slow, inflation continues to be stubborn, and on a 6 month basis in the US, on a 6 month basis, the trend is definitely up. It's not dramatically up, but
Right.
it's definitely, the trend is up. You see a continuation of that trend, and then you see the stock market roll over. I think you're going to start to see interest from North American investors in gold.
Yeah, absolutely, Adrian. You absolutely nailed it. And didn't the same thing happen in the 70s where initially the inflation was out of control, they raised interest rates, then they cut them too early, and then inflation shot out of control, even worse? Are we facing a similar scenario?
Yeah, I mean, similar. Let's quote Mark Twain once again. History doesn't repeat, but it rhymes.
Right.
Yeah. I mean, the story in the 70s was a little bit different. If you look after, obviously, you had that first bump in gold from when it was, when the government controls were lifted. So it went from $35 to 200. That was just a loaded spring.
Right.
Then we had the recession in the mid 70s. But after the end of a recession from 76 to 80, we tend to forget that interest rates were moving up every single month or every single Fed meeting. They were raising rates. The problem was that they were raising rates slower than inflation. And so they
Right.
were always lagging inflation. And that's why gold was shooting up. And then you're right, we did have a short period where rates were cut, but they were cut too soon. When Volcker came in, he dramatically raised rates, as you remember, or as I remember, and as you read in the history books.
Right.
So the T-bill rate in the US went to 22%. The short term T-bill rate went to 22%.
Wow.
So he got rates dramatically ahead of inflation, and that's what killed inflation. But we're not there at this point. But the Fed is too hesitant to raise rates sufficiently to kill inflation. And frankly, I'm not sure that they can do it given the state of the economy and the state of debt.
Right.
That's the huge difference between now and 1980. Not to take anything away from Paul Volcker, who had the courage to do what was needed, but the debt levels, both government debt and private debt, were much lower then. With debt levels where they are today, you simply couldn't raise rates. He put rates double the rate of inflation.
Wow.
Nobody in the US believes that inflation at this point is 2.7%. Nobody
N-
believes that.
No.
It's just not the case.
Right.
So the Fed, I don't think, simply could put rates to where they need to be. The fiscal problem in the US is already very, very, very desperate, frankly. If you count off balance sheet liabilities, like things that have been promised but aren't accounted for, you're talking about $136 trillion of debt, national debt. You've got a budget deficit that's about 7% of the budget every year. Sorry, the interest on the debt. And so and they're trying everything they possibly can to sort of control that. They've depleted the reserve. They're doing more at the short end, which of course low interest rates are lower at the short end, at the long end.
Right.
Whereas an institution like the government should be funding itself at the long end, just like big companies will take on long-term debt
Right.
rather than constantly short-term debt. But they're doing everything they possibly can to minimize the impact in the immediate term. And I have to say, President Trump has a desperate situation, situation facing him when he comes in. I don't know how they're going to deal with it, but I guess a conclusion would be that that is only a positive for gold.
Yeah, absolutely. And I guess my question to you, Adrian, would be, do we need to have a massive, massive recession or a massive type of collapse in the economy to fix everything, to fix inflation, to fix all of this stuff? Or how do you even fix it without going through a recession?
Well, no, I think unfortunately you're right. The problem is we postponed, every boom has to be followed by a bust. That's basic Austrian economics. And
Right.
if you allow the market to operate, then when the market gets a little bit overheated, you can have a short term and definitely a short term and often relatively shallow recession to take care of the excesses and start again. When you try to postpone the pain for as long as you possibly can, then
Mhm.
you're just building up worse distortions, you're building up worse debt, and the ultimate recession that needs to happen is only that much deeper and that much longer.
Right.
I mean, we never really cleansed everything after 2008. In the US, and I know in Britain and in other countries as well, the government came in very, very quickly to support housing prices. I mean, that's why the Fed was buying mortgage-backed securities. And we never really had a cleansing, which is what we need.
Because in 2008, the story goes as, they bailed out the banks.
Exactly, exactly. I mean,
Right.
exactly. That was purely to bail out the banks, not to bail out Main Street. That was very, very obvious.
Yeah, absolutely. Now, what's I guess other than everything we've talked about so far in this episode, what's the main concern that you're looking at in the economy? Is it the repo market? Is it the commercial real estate? Is it bond market? What's concerning you the most, Adrian?
Well, certainly commercial real estate is a big problem, but um, often when problems are well known, they're less of a problem than when they're less well known. I mean, I think one of the biggest problems, frankly, is, well, there's two big problems that worry me. One is employment. We had a big jobs number on Friday from Bureau of Labor Statistics.
Right.
And everybody's saying, oh gosh, how strong the labor market is. 256,000 new jobs created when that was not quite double, but it was about 70% above estimates, well above the previous month. And everybody's saying, oh, the employment picture is very strong. But the day before that, we had as you probably know, there's in the US, there's a private company that does a job survey. And that's only on private jobs, but the ADP survey showed 122,000 new jobs. Bureau of Labor Statistics came out the next day and said, no, 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 256,000 new jobs. Well, they both can't be right. One of them is wrong. And we're seeing a widening gap between the ADP and the Bureau of Labor Statistics.
Hello, my fellow silver and gold stacker. I just wanted to say thank you so much for watching the channel. Subscribe, please like the video, and also hit the notification bell. Keep stacking.
Really over the last couple of years. In fact, this is not just me saying, I mean, I think the Bureau of Labor Statistics reports have become increasingly meaningless, frankly.
Right.
And it's not just me saying that, but in more diplomatic language, one of the Fed members, Michelle Bowman, said that they're becoming increasingly difficult to interpret. So there's several things going on there. One is, let's not forget that we have a very low labor participation rate.
Right.
So if you're excluding from your unemployment rate, you're excluding half the people that just aren't looking for jobs anymore.
Right.
The situation is obviously worse than it is. You've got an average work week of about 34 hours, so considerably less than 40 hours a week. That's the average wage week. I mentioned the ADP, but the most important thing of all about the Bureau of Labor Statistics reports is the constant revisions. I'd be willing to bet you right now that the revisions to the December numbers are going to be downward, not upwards.
Right. So
If you
they
look
can keep
over,
revising.
yeah, if you look over the last 2 years, they revise each monthly report twice, the first revision, the second revision. If you look at the second, the second revision,
Right.
the final revision, over the last 24 months, I think it's something like one, two, three, maybe four at the most of those months have been revised upwards.
Okay.
The rest have been revised downwards. And the upward revisions tend to be very small. So the basic point is you just can't trust the BLS statistics anymore. It's three C's. It's either a conspiracy, it's incompetence, or it's that they're just too complex. But whatever
All
the
the
reason,
above, all the above probably.
maybe, yeah, but whatever the reason, you simply can't rely on them anymore. And again, we've had a Fed member saying that just last week.
Wow.
So I
That's
think the
crazy.
employment situation is a lot worse than it appears. And one other thing, if I may, on employment
Yes.
is taking, the continuing claims are continuing claims mean people are out of work and so not a new claimant, someone who's just lost a job and goes to get unemployment for the first time, but someone who's getting unemployment on a continuing basis. That number, what we call continuing claims, is continuing to go up. And the average length of time from someone losing their job, whether they quit or are fired, either one, but from the time they first get a claim until they find another job is now over 24 weeks, sorry. That's half a year. These are
Wow.
people looking for jobs, and it's taking them half a year to find a job. Now, another point is worse than that, because remember that a lot of people, I mean, this is a little nerdy perhaps, or getting into the weeds, but a lot of people, when they leave a job, they will get, particularly if they're laid off, they will get severance. Well, you can't claim unemployment until your severance has ended. So for a lot
Mm.
of people, they may have already had 1, 2, or even 3 months if they're in a higher position, but 1, 2, or 3 months where they were unemployed. Add that to the 6 months where they're looking, that's 9 months before you find another job.
That's absolutely crazy.
Yeah. So I think the employment situation is a lot worse than these headline BLS, the unemployment number, which is distorted by the labor participation rate, and the jobs report numbers would suggest. I think is a lot worse than that.
Yeah, you can never trust the government data. It's always so, yeah, you have to be very, very careful with it, especially the inflation data itself, not even the jobs reports, but the inflation data to them telling us it's around 2%. When you look at shadow stats, it's a way, way higher than 2%. Yeah, it's just a complete distortion.
Right, right. Well, nobody I know thinks that their cost of living is going up less than 3% a year.
No, yeah, look at
No.
insurance. People have been talking about insurance is like 15, 20% alone in a year.
Um, my daughter's insurance, if I may, this January went from 323 to 379. That was the
Jeez.
increase in January. So yeah, and then that she's not alone. I mean, that's
Oh yeah.
yeah.
There's a lot of people across, even in Canada here, insurance just keeps going up. Groceries is a lot higher than 2% in a year, I'll tell you that. It's for
No,
sure
absolutely,
around 20.
absolutely.
Yeah.
Now we have to, when we think about insurance, I mean, health insurance, to me, one of the problems is that health insurance in North America, and particularly in the US, where it's given out by companies as a benefit and everybody just expects it, is it's no longer what the original function of insurance was. Insurance is not meant to pay for your weekly visit to the drugstore to pick up some aspirin. It's supposed to pay for those rare but very, very large expenses.
Right.
And unfortunately, in the US, Obama. So I used to have a very high deductible policy, um, uh, but it was a policy. But if I had a catastrophic illness or an accident or something, it would cover 100% of it, however expensive it was. And the worst thing people can do is get an insurance thing that covers their weekly trip to the drugstore or their dentist, but has a cap on how much it pays for a catastrophe. The
Oh,
whole
that's
point of insurance is to protect you against that catastrophe.
yeah,
But
not the
Obamacare
small
down here,
purchases.
yeah, Obamacare down here made basically outlawed high deductible policies. And so it's not a surprise to me that insurance costs are going up and up and up. I don't, I'm not a fan of insurance companies, but I don't blame the insurance companies because, if you, one of the things I do a lot of when people tell me, oh, these people are just ripping the public off, I look at what are the returns of that sector. People say, oh, the oil companies are just ripping us off. Look, Exxon made tens of billions of dollars of profit. Look at their returns on invested capital. And you see that the returns on invested capital of drug companies, and I'm not a fan of pharmaceuticals at all,
Right.
but they put so much money into research for drugs that never come to market, right? We don't think about that. But all the money they spend and the years they spend on drugs that never come to market. So you look at the returns on invested capital for pharmaceutical companies, for oil and gas companies, and they are very, very low returns
Wow.
compared with the index as a whole. And so these companies, and the same goes for healthcare companies. So, that's a test to me of whether those companies are, quote, ripping us off,
Mm-hmm.
which is not a concept that I sort of believe in anyway, because in a competitive free economy, people don't have the ability to rip you off. But
Right.
anyway, that's a tangent. We're going.
Yeah. No, you know what, Adrian, it's such a huge, huge pleasure having you come down to Wall Street Silver. Everyone watching, I want you guys all to follow Adrian and his social medias. Adrian, where can people follow you?
Well, the website is adrianday.com.
AdrianDay.com. So yeah, I'll
Yeah.
put the link in the description below. Everyone watching, please hit the like and subscribe button. And Adrian, such a huge pleasure having you come down to Wall Street Silver.
Well, thank you so much. Thank you. And sorry about the tangent.
No, no, I love it. That everyone's gonna love it too. Awesome. Talk to you soon, Adrian.
Okay, thank you.